Hello everyone and welcome back again to my YouTube channel. So my name is Pakwesi. So if you are new to the channel, please kindly subscribe to the channel, give a like to the video too as well. So in this episode, I'm going to be talking about reasons a lot of us get stopped out when we enter a trade. And this thing has been it has been depressing a lot of people. It has been frustrating a lot of people, and it has even ended up like some people want to give up in this game because anytime they enter a trade, they easily get stopped out and the market will go in their favor. So in this episode of my YouTube videos, what I'm going to be doing is what I'm going to break down the things, the reason you get stopped out most often. So if you are new to the channel, as I said, kindly subscribe to the channel, give a like to the video too. So reason why you get stopped out most often when you enter a trade. Reasons. So the reason why you easily get stopped out when you enter a trade, anytime you enter a trade, you get stopped out and the market will go in your favor. So this thing is very frustrating. So let me give you this story. So when I started out trading, I was in this group. So you were using the same system. You used to trade Elliott wave. So those who have not heard of Elliott wave is simply like trading. It's a pattern, okay? It's a pattern that you used to trade. So what happened most at times is what we easily get stopped out. We know the direction of the market perfectly. We mostly get the direction of the market. You get so if you have been following me for long, you know that I easily predict the market, but sometimes the most difficult part is what the entry. So we easily get stopped out. The reason why I'm very good in predicting or determining the direction of the market is because I learned Elliott wave, so I understand market structure very very well. So we easily get stopped out most often because of what this reason. So one reason why you mostly or easily get stopped out is what you are trading against the trend. Okay, so no matter the time frame you are trading, if you trade against the trend, I'm not going to say like trade the H1 time frame, trade the M30 time frame, but any time frame you are trading, make sure you trade with the trend. Okay, so one reason is what trading against trading against the trend. So if you trade against the trend, the thing is what you are going to easily be stopped out. So if you have been stopped out most often and it become very hard for you to understand why you easily get stopped out, it's because you are trading against the trend. So what market structure does for you is what market structure is going to help you to know the direction of the market. So if you don't know the how to read market structure, that is when you mostly get stopped out. You get it? Because one thing is what the market is like a language. You need to understand what the market is telling you, the language the market is trying to what speak to you. If you don't know how to interpret the market, that is when you easily get stopped out. So trading against the trend. If you trade against the trend, you are easily going to be stopped out because one thing is what the market is in phases. It's either moving in what impulsive phase. Impulsive phase simply means when the market is in the direction of the overall direction of the market. That is what impulsive phase of the market. Okay, so let's say an uptrend for an example. Taking an uptrend as an example, this is an impulsive phase of the market. Okay, and this is the corrective phase of the market. This is the corrective phase. This is the corrective phase of the market. So the reason why I don't recommend one to trade the correction is what when it comes to correction, the market does not flow smoothly. The market does not flow smoothly. So if we are trading against if we are trading against the trend, that means we are trading the corrective move of the market. The corrective move of the market. So if you trade the corrective move of the market, one thing you need to understand is what the corrective move of the market is mostly choppy. Okay, it mostly consolidates. And when the market is consolidating, because it is not moving in one direction, the candles are not moving smoothly, you can easily get wigged out. Okay, you can easily get wigged out. So the market can wick and what later move in your direction. So this is the wick. So supposing maybe you have placed your stop loss over here. If you have placed your stop loss over here, because you are trading the corrective phase of the market, and when it comes to corrective phase of the market, since the market doesn't move smoothly, since the candles are not moving, like we are not having bigger candles which is moving smoothly with the direction of the market, you can easily get stopped out by the wicks. Okay, so when it comes to the corrective phase, one thing about the candles in the corrective phase is what they are mostly a lot of wicks. Okay, we don't have clear body when the market is moving in the corrective phase. So the market mostly wicks because the market overall should be what, in an uptrend phase, and sellers are trying to what, push themselves into the market. So since buyers are what, having much control, sellers are struggling to control or be asking dominate the market. So that's why you see most often when the market is correcting in corrective phase, it kind of doesn't move smoothly. You get it? So the reason you get stopped out is because you are trading the corrective phase of the market, and which sometimes become very difficult for the candles. If it is in an uptrend, the bearish candles become very difficult to what, to fall. And when it is a downtrend, the bullish candles. So this is a downtrend. So the downtrend mostly when the market is in what, when the market is trending down, the downtrend mostly is what, you see lower lows and lower high. Lower lows means what, a continuation of what, a continuation of bullish bearish candles. You see continuation of bearish candles. Okay, so when the market starts moving against the trend, when the market is trending down, you mostly see what, bullish candles. Okay, so when you see most of bullish candles, one thing you need to understand is what, these candles are what, correction candles. Okay, or reversal or retracement candle. So most often when the market is in what, a downtrend, and you see bullish candles, you are not going to see like bigger body of a candle. As in, you are mostly going to be seeing wicks. The market will be moving slowly. You get it? So it is always advisable to be trading with a trend. When you trade with a trend, so you can check, you can go to your chart and be checking how the trend, the candles that are moving with the direction of the market, and you notice that most often when the candles are moving in the direction of the market, you see bigger candles. If I've not joined my training before, I'm going to be having an upcoming training which is going to be coming off on 15th of July 2025. So if you want to join or if you want to participate, kindly check the description. My number is over there. Book your seat, and what, all these things are going to be explained in what, details. Okay, so one thing is what, you don't have to trade against the trend. So I'm not going to be saying focus on this time frame, but always, as you know me, if you've been following me for long, I always or mostly preach about what, trading the higher time frames. Okay, trading the higher time frame, especially my magical time frame is what, the H4 time frame. H4 time frame, I mostly trade the H4 time frame. Okay, so if no, I'm not going to say follow what I'm doing, but if you want to trade any time frame, make sure you are trading with the trend. So the reason you get stopped out most often is because of what, you are trading against the trend. Okay, so know how to read the market. As I've been saying, the market is like a language, and if you don't know, understand how to read the language of the market, you are going to be stopped out most often. Okay, so trading against the trend is one reason why you mostly get stopped out. Okay, and another reason is what, trading at the wrong timing or wrong section. So let me use this as an example. So wherever you are watching me, if you go to your local market, you have specific time or you have certain times that most often when you go to the market, you are going to be seeing a lot of people in the market. You get it with your local market. So me, for instance, that I'm in Ghana, if you go to Mokala, I'm in Accra as I'm talking to you now. So if you go to Mokala, you are going to be seeing a lot of people, especially in the morning, in the afternoon. By getting to 9 p.m., getting to 10 p.m., it's going to be very difficult for you to see people in the market. You get it? So it's the same thing when you bring it to the forex market too. So with the forex market or with the financial market, we have certain times that the major market players, the institutions, the corporations, okay, the government mostly what makes transaction or do transaction. So if these people are absent in the market, if these people are not present during that time, one thing you are going to be experiencing or one thing you are going to be noticing is what, the market is not going to move massively. So we have active market sessions that you are supposed to trade. You get it? So the reason why you mostly get stopped out is because you are trading at the wrong timing. You don't understand. You wake up any time of the day and you start trading because the forex market is what? Because the forex market opens 24 hours a day, 5 days within a week. You would think like you can just trade any time of the day. It doesn't work that way. So you need to understand the market timing. the active market session. That is when the institutions start participating in the market. So let me take this one as an example. So if you go to your bank, okay, wherever you are saving, if you go to their physical location, there are certain times that they start their operation. Okay, so taking maybe if you go to the bank, they start operation maybe 8 a.m. to 9 a.m. That is when they start the operation. So before those times, they are not making any transaction. They are not doing any as in big volume, big transactions. You get it? So when they are not doing those big transactions, the market becomes dry. So the moment they start operation, that is when they start transferring huge sums of money. So that is when what the market starts. You see bigger candles. So if you trade at the wrong timing too, you are going to be getting stopped out a lot of times. So no matter, one thing you need to understand is what, no matter your setup, if maybe you have a certain pattern or a particular pattern that you trade and it has aligned perfectly at a wrong time, you are going to, don't take the trade. Let me put it this way, don't take the trade. Okay, because you are going to be stopped out. The market doesn't care about your patterns. The market doesn't move. Basically, the market doesn't move based on the drawings we draw on the line, based on what the patterns we focus on. That is what you need to understand about the market. The market is moved based on fundamentals. Okay, especially with the forex market, with the stock market. Okay, market moves based on fundamentals. So what are some of the fundamentals am I talking about? The market moves based on GDP. The market moves based on inflation data. The market moves based on interest rate. The market moves when this what governance of the what the central banks are speaking. That is when it moves. The market does not move based on your support and resistance levels you draw on the chart, based on your trend lines you draw on the chart. The market does not move that way. So what those are indicators that guides us that this is the path the institutions are following. You get it? So it does not move based on our support and resistances, the Fibonacci, the fair value gaps that you people trade. The market does not move. So you need to understand the fundamental part of what the market is. So I will take time and break fundamentals too. Okay, you need to understand that the market moves based on fundamentals. It does not move based on our technical analysis. So if you trade at the wrong timing, you are going to be stopped out. So with this one, so I'm going to explain it in depth. I'm going to explain it in details when I'm doing the training too. So the last one is going to be when you place your stop loss at a weaker time frame support and resistance. So let me take this as an example. When, let's say, maybe you are a military man, you are going for war or you are in a war field, you can't just go and stand at any place or at any grounds and you start shooting. That is not how it works. You need to hide and you shoot. You need to hide like a sniper. That's how snipers do. They will hide and they will shoot. So it's the same thing in the market. You can't just stand at any level in the market and you place your stop loss. So the reason you get stopped out is because you are using lower time frame support and resistances at your what? Your stop loss levels. So reactional levels can be support and resistance. You get it? Support and resistance levels. If you use weaker time frame levels as your stop loss levels, you are going to be stopped out. You get it? You are going to be stopped out. So stop loss basically means what? It's a command that you are going to give your brokers that this is the level that I'm going to accept I'm wrong. So the moment the market gets to those levels, you should take me out from the trade. Okay, so those who are new, those who are beginners who don't understand stop loss, when you talk about stop loss, it is like a command that you give to your brokers. You get it? So if you have been saving in the bank, for instance, standing order, when you talk about standing order, it simply means what? You are giving your bankers a command that at the end of a month or at the middle of the month, anytime a money hits your account, they should transfer this amount of money towards your maybe current account or maybe your savings account. That is what you call what? Standing order. So when you bring it to the forex market, when you bring it to the financial market, when you talk about stop loss, it simply means you're giving your brokers a command that when the market gets to this level, they should take you out from the market. Okay, so maybe I'm anticipating the market is going to move up. Okay, when the market decides, since the market is a probability game, when it decides to come down, this is the level that I'm going to accept I'm wrong. So this level is going to be my stop loss. So it's a command that you are going to give to your broker. So the moment the market gets to this level, I'm going to agree or accept that I'm wrong. Okay. So when you place your stop loss at a weaker time frame, so for me, for instance, or as an example, the weaker time frame support and resistance, the time frame that I consider it to be what? A weaker time frame is what? Especially the M1 1 minute time frame, 5 minute time frame, 15 minute time frame. Okay, this and M30 time frame, for instance, I don't use those levels as what? my stop loss levels. The levels that I prefer using them as my stop loss levels, I place my stop loss. If I'm taking a buy, I place my stop loss below those levels. When I'm taking a sell, I place my stop loss above a higher time frame what resistance level. I consider these levels, especially the monthly time frame, the weekly time frame, the daily time frame, the H4 time frame. These are the levels I use as what my stop loss levels. I don't use weaker time frame. If I don't see these levels, I don't place my stop loss below and above this reactional levels time frame. You get it? So when I started doing these things, the market, it becomes very difficult. I hardly get stopped out unless maybe I'm wrong with the direction of the market. But if I'm correct with the direction of the market, I hardly get stopped out. So the stopped out that I'm talking about is what sometimes some people will enter a trade. Okay, they know the direction of the market. The market will move later, will move in their direction, but before the market will move in their direction, they are going to be stopped out before the market will start moving in their direction. You get it? So that is what I'm talking about. Always use higher time frame reactional level, support and resistance. So if you are taking a buy, use higher time frame, maybe support level as your stop loss. If you are taking a sell, okay, use higher time frame reactional level, maybe the monthly, as I've stated or indicated, the daily and the H4 time frame reactional levels as your stop loss, about your stop loss levels. Okay, and when you start implementing these things, I bet you are going to what it's going to be very hard for the market to what stop you out, unless maybe what you are wrong with the direction of the market. I'm not saying when you start implementing this thing you are not going to be losing. The market is all about what probabilities, but we are talking about the chances of you getting stopped out more often. That is what you are talking about. The probability at this point, your probability that the market is going to move in your favor without or you being get stopped out is higher, okay, as compared to you being what stopped out. Okay, so currently I'm going to be having training which is going to be on 15th of July. So if you're interested in joining the training, I'll put my number in the description. Check the description, chat me up, and I'll add you to what the training. And it's going to be, I'm going to explain a lot of things. Those who have passed through my trainings can attest to that, because there are more gems that what I give it to them during the training. I explain everything that I mostly what know about the financial market, and those who started implementing what I talk about have started printing money for themselves. So if you are interested in joining the training, kindly check the description, chat me up on WhatsApp, and what you are going to take it from there. So see you all next time. Bye.